The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, everybody, welcome to a new day in trading here, and welcome to the Diagnostic Trading Hour with Darrell Martin. If you have any questions, feel free to call in. So we're available and ready to take your questions. So questions about futures, Forex, ETFs, etc. Just feel free to call in about that, and of course about Nadex as well. And the number to call in on is 1-877-927-6648. Or if you're outside the U.S., call 727-445-1044. And quick wrap right here on the markets, just looking at everything and how everything's doing. We got the S&P moving up a little bit, and it's up about 0.4% right now. And we got the Russell up just a little bit. We got the NASDAQ leading the group up 1.3%, and the Dow up just a little bit. We got the oil up 3%, making some big gains today, all the way up to $93. And we got the currencies also moving, but not too much. But we got the pound dollar is making a bit of a run, along with the Aussie dollar. They're up about 70 pips. And corn is actually pretty flat today comparatively as far as its up move so far. And soybeans is actually up 1.7%. So, there's quite a bit going on in the market. Definitely some trading opportunities out there and a lot of things to look at. And, one of the things I wanted to go over with you is something that I heard on the last show, and something that you just, you always want to be aware of. And that's, just what's going on in the market cycles in the market, and people that just are not, ready for that. And so, you want to understand, what are the market cycles? What's going on? What's the fundamentals? And that's what we talk about at the Diagnostic Trading Hour. We go into how to limit risk using Nadex. We talk about how to maximize your leverage, but we also go into how to be one step ahead of the markets. And the way to be one step ahead of the markets is really going to require that, you understand basic things that go on with the market. And those four areas that you need to have a, basic understanding of are things like the technical analysis, such as, Fibonacci, patterns, indicators, volume, things like that. Not that you're going to make all your trades based on them, but that they're definitely going to be clues about where orders are, where order flow is going, mainly because that, it helps you understand where the orders are located. Also, look at fundamentals, what's going on in the economy, what's going on with earnings, what's going on with Europe, on down the list. And you're going to look at your seasonal factors. So what is the seasonal cycle of the markets? And you're also going to want to look at statistics. So basically, what is an expected standard move for a day, a week, a month? And that really helps you set more realistic expectations. A lot of times, we can think something's going to shoot to the moon or, fall all the way out of the sky. But the options market is very good at telling you what its expected move is. And so you can use that to really help you in your trading, no matter what it is that you're trading. So whether you're trading options, futures, Forex, stock, ETFs, bonds, whether you're trading Nadex products, however you're trading, you can use all of these factors to, help you put everything together. And we talked about this yesterday. I just really want to bring it up to make sure that you understand, and we can even sort of see it, going into effect right now. But we had a high, if we back up on the chart a little bit, we had our high right here back in 2011. We're basically right at the same price, okay? And that we were back in May of 2011. But also, we're basically at the same point, fundamentally, as we were back in 2011 in July, right before the market decided to sell off. So it actually did a rally on, got it right here the 19th. Does that sound familiar, right? And it kept moving up and moved up, and then all of a sudden it started to sell off on the 25th. And this is when the whole debt crisis, the, ceiling issue, whether they're going to raise spending, tax cuts, all that stuff. And they said, hey, we're going to put it off for a year, right? And, we'll decide January 1st, 2013, and we'll figure all that out. Well, of course, they put in all these automatic triggers of spending cuts. Nobody wants to deal with that. And that's we're basically in the exact same boat, and we're gonna have more gridlock now than we've had in the past. So just make sure that you're definitely checking that out and looking at that, and considering that as you go into the market, if you're placing any kind of position, specifically if you're placing any positions on the looking to buy long, to actually hold a position over a course of a period of time, is you want to be very, very sensitive to what's happening right now. We have, of course, the whole German debate going on. They're like, hey, we support helping bail out Europe, but we definitely have some other issues with it, and we don't see Merkel's coming in. She's like, I don't see why all the Germans should actually be on the hook for helping out with covering all these other countries' bad management of their money. And so she really has a big issue with this whole Eurobond issue, and that really was the issue that has everybody in an uproar. Is like, what are they going to do? How are they going to handle it? And they just don't know how they're going to put all this together. So be ready. So I think we're also going to have a pullback, and it sounds like a lot of the other guys are sort of on the same boat, expecting a pullback in the market. And it was interesting today. We had quite a few things happen, but if you look at the reports that came out, and go over these resources usually whenever we have our show, and one of those is I go to Forex Factory, and we're going to get a data feed of this actually into the website for you soon, so you don't have to go to different sites and everything. But right here is a free site. You can go over, click on the economic calendar, you can check out what's going on, and you can see right here on existing home sales that they came in under expectations. So basically, it was expected. I was reading reports by Bloomberg or everybody else that they were going to be much better than expected. They obviously weren't better than expected, and the market basically sold off a little bit on that. We also had unemployment claims come in higher than they expected them to be, and so the market sold off on that. And we talked about some different trade setups you could do, and how you could go in and how you could look to buy or sell the spreads. You could even hop in after the announcement, and take advantage of that with binaries and things like that. And one of the things I wanted to go over with you was looking at statistics and sort of determining, when you're looking at it, how to use that to your advantage without having to do a whole lot of complicated math. And there's a lot of different tools out there. We're going to make a tool for you and put it up on the site here in the next few weeks that'll actually help you do this automatically. It's pretty easy to use. And but it's a way to go in and analyze and just look at what standard deviations are. You can use different indicators for this as well. One of the tools that I use, it's a free tool that comes with Thinkorswim. And not so much I'm looking at the price levels, okay, but I'm looking at what's called the standard deviation. And I go over here and say I put in like the S&P E-mini futures, and then right here I go down and I choose my mode. So I say basically one standard deviation up, one standard deviation down. And what I'm looking at, what's important to me again, is not the price levels, okay, because like right now this is based on the market started at this price. What's important to me is the difference, okay? So 1372 to 1382, 8 points, and we got 1373 down to 1363, a 10-point down move. That's a one standard deviation move. That should cover 68% of the expected move in the market. So when you're looking at that, you go, okay, well, what did the market actually, what price was it trading at yesterday? So if we go in and we pull up a chart on the S&P, and I know I have one up here, but let me pull up one where we can zoom in on it a little bit. And we'll pull in that chart on the S&P, and we'll go back. We're going to back up, and we're going to look at yesterday's closing price, okay? So yesterday's closing price right around, let's see here, if I pull up the data window, we can see the closing price around 315 or so was 1354. Or wait a minute, here we go. So closing price was around 1367, okay? So basically what they're saying was that based on the standard deviation move, the most you should really count on is either an 8-point up move or 10-point down move. It may move a little bit more, but that's really the range you should be expecting. So with the closing price being right around 1367, I mean, you could also look at, the 3 o'clock, closing price as well. And with that closing price being right around 13, basically the same price, then you just do, real simple math. Once you know that it's, 8 to 10 points, so you could just say an average of, 9 points, and you go into so we do 9 plus 1367, okay? So that means we should basically expect to move up to 1376. Well, let's look at, how it's doing so far, right? Where are we at? Where's our high? So right over there at 1376. So our high of the day is 1376 to the penny, okay? And we can go over here, and we can also do the same thing on the downside. So if you're looking at that, so we take 9 off that, and that's where we were at yesterday on the close, approximately, give or take. So minus 9, 1358. So the most of the down move you should expect is about 1358. That's really the range you should expect the market to trade in over the next 24 hours, okay? So you can do the same thing at the end of the trading today. Look at the standard trading deviation and go, okay, what is the expected move for Friday? And that's really a helpful factor because it helps you put a lot of things together including the ability to go in and know what your expectations of profit target should be, stop losses, reversals. So if you think about, I can use this for reversals, I can use this for profit targets. It really can help you out. So if you were in and you were say long on the S&P 500 this morning, then you'd probably be looking at possibly taking a profit at this point. If you did have a bearish sentiment on the market, then right up around this price level would be about where you'd be looking to get short on the market. So putting those things together really does help quite a bit, puts a lot of things in line for you, and allows you to have an expectation not based on your belief, not based on all the hype, and not based just on different people's opinions, but actually based on how's the option market pricing in the expected move. And so if we go ahead and we look at that, and how would that have played out today? Okay, so what we can do is we can go in and we can pull up Nadex, and let me see here, I'll pull up a Nadex window for you, and we'll log in. See, I had one of them open. Let me see if I got that one open for you, and you can take advantage of that. And what that'll allow you to do is go in and actually, analyze and look backwards at the trades. So let me log into this right here. Go over here. And what we'll be able to see is, where did the market move, and how could you take advantage of that with spreads and binaries, and then of course, or binaries, and then how could you take advantage of that looking at the trades that were available before the news this morning. So if we go in and we look at the indices, bull spreads, and we go in and we check out, say, the US 500, then of course there were earlier trades that you could have taken advantage of. But let's go ahead and just look at the dailies, so the 8 to 415. And then we look at, okay, where did the market open? So if you look at where did the market open this morning, or where was it? Right around 7:30, okay? So instead of the open, we'll look at 7:30 Central Time, 8:30 Eastern Time. And this is just right before the news announcement. We basically had the market trading right around 1374, 1375. So, well, if we go over and we check out the spreads that are available, there was a 1375 to 1345 spread. So we could have went in, pulled this up, and clicked on the chart right here. And you probably would have clicked on the chart immediately at that point, but you can click on the chart and sort of back up and see what the available options were for you there, and sort of see where the price was. So you could have got in earlier in the morning. You could have got in right around 1372, and you would have been able to sell on the market, and then the market dropped down here to 1366. So expecting that move, where would you want to take your profit? Okay, so we'll talk about that when we come back on knowing where to take your profit based on standard deviations, because that's where orders are going to be placed in the market. Hold on right there, folks. We'll be right back after the commercial break.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kay Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, everybody, welcome back to the Diagnostic Trading Hour. So market's pretty much where we left them last. And last time we were talking about, okay, so if you decided to go in right before the announcement here and go short the market because you expected unemployment to be worse than expected, then where would you expect to take your profit? And we talked about basically the average of the 10 and the 8 standard deviations on each side, looking at a 9-point standard deviation move. What would the expected move down be from where the price was currently trading? And so to be able to do that, what you want to do is you want to look at the most recent high. So if we go right here, this is actually the high, and but it happened obviously you wouldn't have that high because it's 730. So go back and look at the last most recent high. And that's going to be over here basically at 1375 from the overnight trading. And so if we go in and we pull that up and we look at 1375, okay, and then we subtract the 9-point standard deviation move that's expected in the market, then you should expect a move down of about to 1366. And if we look down where the market actually dropped down on that standard deviation move, then you're actually going to see that it did literally drop down just to 1366 before turning around. So you're probably going to want to take your profit obviously a little bit before that. And one of the clues you would have had is we're looking at the close of yesterday when the gap fill took place. And the market started moving down, had the unemployment report. That came in, of course, worse than expected. It did a little bit of a retracement after the market opened, and it was waiting on the home sales. Home sales came out worse than expected. It continued its move down. And again, it basically made that full standard deviation move back down. And so taking advantage of that move, you'd want to be taking profit at least by this point, or at least tightening your trailing stop on your profits. And You'd also probably consider, taking profit maybe even before the close of yesterday. So that's, obviously the gap fill play, and you can take advantage of that. So it really helps you when you understand standard deviation and where the orders may actually be placed in the market. And so that way you can have a realistic expectation on where to take profit, because you don't want to take it too soon. You obviously don't want to wait forever and give it all back. And so this is a trade I did here this morning, and I had some people on. I was talking to them. I was like, yeah, this might be definitely a point that you'd want to take profit on the trade. So anyways, just make sure you keep in mind of that. Use your standard deviations. They are huge. They're easy. You can use simple math or simple platforms to help you out with that. There's a variety of indicators that can help you out on that. And you can use it not just on S&P. You can use it on Microsoft, on Apple, on Google, on the bank stocks, everything. So it can come into play, and you can take advantage of it. And you want to look at what was the closing price of yesterday, and what's the up and down standard deviation move. Just take that average. So we had basically an up point, 8 point up and 10 point down. So we took the average 9 points from the closing price. That's how high we expected it to move or low. Doesn't tell you direction, just tells you distance. Okay. And when it did move up and we got in, what's the retracement level that we should expect based on that move? And we put all that together, and then we have a price point. That price point lined right up with the ability to also fill a gap on yesterday's overnight, basically the overnight run from last night, and fill in the gap to yesterday's close. So after that came out, that sort of wore off. Market pulled back up a little bit, and again, where would we expect it to pull back up to? About 9 points up, right? So we go in, and again, you can use this for swing trading, for trend trading during the day, for a lot of different things. So you see the market start turning around, and you look, okay, well, what was the low over here? Well, the low was 1366. Add 9 points to that, and that gives you a move up to about 1375 is about what you should expect. Well, it hit that, it spiked a little bit above it, and then started moving back down. So if you want to play the trade again, okay, then that's where you may decide to sell again. And of course, from from the new high, okay, 1376 minus 9. So basically, the lowest you should probably expect the market to go down, at least today, is down to about 1367. So about right at this level right here. So that would be the move down. That would be the most really that I would want to expect, and that's probably where I'd be looking to take profits on a trade. So how can you trade this using the Nadex binaries and bull spreads? We were last on, we talked about actually pulling up one of the possibilities. And we were pulling up a chart, and we were looking at the different price levels. And basically just talking about, like I said, different options that are presented to you based upon which trade you want to do. So if you're doing that and you got in, you'd probably be selling right around 1373. And that's pretty much what we got just by looking at the chart over here, sort of the high point in the price, about 1373. And then you'd be able to take it off about as low as 1370 or lower. And if you did that, maybe actually 1360. So yeah, about 13. That'd be about right on par. So somewhere around 1368 to 1369. So you'd have a 5-point profit. You had a 2-point risk. So you had $100 risk on a $250 profit on that trade if you would have placed that trade. And then, of course, you could have turned around and did it in the other direction and turned around in the other direction. So when we come back, we're going to look at binaries and how to use these standard deviation levels to possibly buy and sell binaries and how you can apply them. All right, stay right there, and we'll be right back after the break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of tfnn.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of tfnn.com.
All right, welcome to the Diagnostic Trading Hour here with Darrell Martin. And feel free to call in with any questions you have. Want to go ahead and go over binaries, how they work, and how you can take advantage of the movement today, the news today, and how you can apply that to your trading with the binary options. A lot of people have the tendency to go in and turn binary option trading into gambling, okay? They go in and they're like, oh, which one has a really low risk? It's like, oh, this is only $4. I'll buy it. This is only $2. Man, if I buy this trade right here, then I make $98 with only a $2 risk. Well, but I mean, there's a reason, because the probability of hitting that is so low, okay? It's way outside our standard deviation range. We remember, if you recall, we were looking at a standard deviation of about 1376 on the upside. And this is all the way up at 1386. Okay, so just keep in mind that you need to look at where you expect the market to move, and standard deviations are really the biggest thing you can use when trading binary options. So if we go in and we expected the market, if it were to move down to about 13, we said 1366, and it did actually move down to that price, exactly to that price, to the penny there. And so we go over and find a binary option, usually a daily. You can also do shorter term ones, but let's say we were looking at a daily because it gives you more range. And we're looking at a daily. We got a 1368 right here, okay? So that's a little bit above it, which is good because we're expecting it to go below it. And we go and we pick that option. So we're going to go ahead and see how would that trade have played out. Pull up the chart, and let's look at the time frame. So looking at the time frame on here, you'll see a few different things. One of the things that you're going to see is we'll back up and let's look at where the trade was actually at. So we got 8:30 Eastern time, okay, that we need to be looking at. And that's when the announcement came out on unemployment. And so you could have went in and you could have sold this binary somewhere, before 8:30, like 8:28 right there. You could have sold it for, it says, about $75. So on the average, we just put it all together. So if we say $75, then, just to see what would that have looked like. If I would have been able to sell this right here up at 75, then I have a $25 risk with a $75 maximum profit. How would I make the maximum profit? Well, at 4:15 today Eastern Time, the market would have to close less than or equal to 1368. But I don't have to wait for the market to close to make a profit. Okay? So what you want to do right here is look at this trade and notice how whenever it came down after the news, you go in and right before the market opened there, you're all the way down. Basically, we hit our level right here and at 58. So we would have made a nice profit, 58 between $58 there. So if we change it up and we go in and we pull up a simple math calculator here, and if we sold at 25 and we bought back, okay, so if it was down at 58, we could buy it back. Or if we sold at 75, we could buy it back. So 75 minus 58. So that trade would have made at least $17, if not more, and we could have held it a little bit longer too. I've got a caller on the line. Let's go ahead and bring him on. Anthony from New York. How's it going?
Pretty good.
Great. So I saw you had a question there about standard deviation.
Yes, I missed how you end up calculating the standard deviation.
There is a formula that I do use to calculate it. I showed a sort of just a quick method in one of the platforms, Thinkorswim, that you can do, and you can go into their platform, and I know they have a show on here, and you can go in and go to their Analyze tab, and you simply put in your symbol that you're looking for. So like say like /ES, and again you can do this on anything. You can do it on Apple, whatever, and then what you want to do is you want to set the date to tomorrow's date. Okay, so right there. And then you want to say +1 at expiration. So at expiration, +1. And then go down here where it says mode, right click on it, and there is a section that lets you basically choose the price mode. And so they got, like a locked price, a live price, a percent, a dollar, or a standard deviation. So go ahead and choose +1 standard deviation. Right here, go down and choose a -1 standard deviation. And so that basically shows you in a 24-hour time frame, the options market is pricing in from the current live price. Now, again, you're not going to base it on, don't look at the price levels unless you're looking at it right at the close of yesterday, okay?
Okay.
But basically what you look at is the difference there. So, we basically have about a 9-point difference between 1371 there and, 1371.25, 1380.75. And then looking on the downside, 1371 down to 1362. So about 9 points up, 9 points down is what's expected. So what I want to do is I want to take that price and I'll go, okay, that's a $9 difference. And I want to take that level and I want to go, okay, what was the closing price of yesterday? So with the closing price of yesterday, we'll pull the chart up over here. And there we go. Being right there at 1367 or so, then we can add 9 points to that and subtract 9 points to that. And that becomes our sort of our range that we should expect the market to move in that day for whatever it is. And like I said, you can go in and you can take any market you want to, even if you're trading, stock or whatever. If you're trading, say, Microsoft, you go and pull Microsoft and just literally follow the exact same steps. And so if it does hit that point, then great. Now I'm looking for a potential reversal on the trade. Or if I still want to stay in, I'm looking for the market to do a pull. I want to definitely tighten my stops at that point because there's a good chance the market is going to go ahead and pull back. And it's so easy to, It's hard, when you're in trades and you're trying to figure out where to take your profit, and a trade's running, it's going really good for you, and it's like, where am I going to take it off? And the standard deviation lets you know, hey, this is what the option market expects to happen.
Yeah, that's my biggest problem, figuring out where to take the leap off the train.
Exactly. So and whether or not you decide to get out, it's like this is a point where maybe you want to start doing an ATR trailing stop, or you want, whatever kind of trailing stop you use, but at this point, maybe even just one bar back, the high price.
Yeah.
So, but that's a point where you definitely want to go ahead and put a trailing stop order in on your trade, so that way you can, walk in some profits. Because if you would have got in, you wouldn't have got out. You'd have let all that profit just dwindle away and come back up.
Yeah.
And came back right up to the same point. Standard deviation bounced, went the other way. And like I said, you can even use this on stocks. You go in. And, looking at, Microsoft, basically, there is expected standard deviation of about 30 cents. So, if we go into Microsoft and then we pull up a chart on Microsoft, and I'll load that up, we can check it out, and then we can see, okay, so what really is the expected move from yesterday's close on it, and minus the after hours trading and all that fun stuff. So let's see, we'll look at the 3 o'clock, the cash close. So basically a 30-cent up or down move. It was at 30.44. So basically 30.74 would be about the high where we'd want to be starting to look to take off our profits. And, if the market were to move up on Microsoft, it did, and it broke that by about 5 or 10 cents, and then you can see it gave it all back. So it's really a cool tool. It's simple to use, and it lets sort of an objective way for you to set some some goals and price targets, and if you like to do fade the trend, it gives you a price level that has a good idea for doing that. Of course, when you fade the trend, you want to make sure you limit your risk, and that's why I like to use the Nadex product, because I can easily fade the trend by say selling a spread or selling a binary.
And I'm pretty new to this game. What's a binary?
Okay, binary is I'll pull it up right here in the Nadex platform. And a binary basically is a true or false statement. Okay, so what you're saying, if you log into Nadex, and you can get a demo account in literally 15 seconds. Okay, and to get the demo account, you just go over to tfnn.com, click on Nadex, and then click on create an account, and then right down here it says open a demo. And then you just fill in username, first name, phone number, email, apply for demo. They'll send you a password right away, and you can log in. So literally, it's a 15-second process. A binary is saying true or false. If you think about, back in the old coding days, right, we had the zeros and ones for binaries. Mm-hmm. So is this statement going to be true or false? So on this one, it's saying, is the S&P 500 September futures contract going to be greater than 1368 at 4:15 Eastern Time on July 19th? If it's greater than that, then true. And if you bought it, okay, you're saying true. So buy means true. Okay? Now, if you sell it, you're saying false, which means you think it's going to be equal to or less than 1368 at 4:15. Mm-hmm. Okay? Now, you can buy it up front, and you can hold it all the way, to the next trading day. You can either buy these at 6 o'clock for 4:15 the next day. They even have weekly ones. You can go in, as you can see right here, there's weekly trades. So you could buy them literally as early as Sunday or Monday and hold them all week. But that's really not the trade I usually do. I rarely like to hold these all the way till expiration. Okay, they're a great way to trade directionally with very little risk. I mean, here's a trade for $25. Mm-hmm. And so as they move up and down, they're going to, of course, change in price. And a way to sort of see how they're going to change in price is, let's say the market moved down and you sold this one, it'd become, for $3. Well, if it moved down just 3 points, then you'd be up $10. So sort of like an option chain, okay? Yeah. It's 13, 15, 20. So it sort of lets you see how far it moves. If it moved right to the same price, so if you sold this at 1380, and it was actually the market was actually at, or bought it at 1380, whatever, then it'd be about 50-50, because that's like a 50-50 probability that it'll expire. So this is similar to probability, but it's not really your best bet on probability. But it lets you see that's why it's $50, because there's a 50-50 level. But on all the binaries, on Nadex anyway, now there are different binary markets out there. All the other ones besides Nadex are on over-the-counter, and most of them are international. Okay, and they have all different ones out there, but they're over-the-counter, and good luck. They're not really under the regulation, all that stuff. Nadex is actually a registered CFTC exchange in Chicago. Again, registered with the CFTC. So sort of a nice comfort level there. And all the binaries. I was saying all the binaries are always going to be worth $100 total. So whatever your risk is, your profit will be the difference. So that's why you can see the profit and loss will always add up to $100.
Oh, okay. So let's say, is that pretty much trading options, where you could, if you buy, let's say you buy a call, you basically your risk is just the cost of the option.
Exactly. So 100%. It's exactly. It actually is a type of option. It's called a binary option.
Oh, okay.
And so, and even the spreads are a type of option. They're basically, I call them box spreads. They call them bull spreads, but they're not bullish. So they're bullish if you buy and they're bearish if you sell them. Okay, but they're a type of option. The thing is, unlike if you do calls and puts, then you got to deal with a lot. You have a lot of time decay in there, right? Yeah. Because at best you have weeklies. So, but you don't have dailies. You don't have ones that are every 2 hours. Okay.
Yeah.
So in here you can have ones that last 22 hours long. You can have, like I said, they are weeklies, but they also have ones that last 22 hours all the way down to as little as 2 hours. And so with not having all that premium in there, then you basically get what's called are you pretty familiar with trading options? Do you trade, off and on trade options a little bit?
I'm not getting into investments, so I have a bit of theoretical knowledge on options.
Okay. Well, on your your standard options, you basically have 5 ways you can make or lose money. Okay. On your normal like calls and puts and debits and credit spreads and all that stuff. You have your row, which is your interest rate. Not really a big factor right now. Okay. So with the interest rates being so low.
Yeah.
You have, of course, movement, which is what's called your delta. So that's how much will the option change in price with a $1 move in the underlying. So if Microsoft moves up and the delta is 50, then the option would go up by 50 cents. Okay, if Microsoft went up by $1. So that's a delta. And then the next one you have is what's called gamma. Okay? Gamma is how much your delta changes. So let's say your delta is 0.5, all right, and your gamma is 0.2. Then if Microsoft went from, let's just say, 30 to 31, then your option went up by 50 cents because your delta was 50. But now that $1 move means now your delta is going to be 0.7. So if Microsoft goes from 31 to 32, then your option is going to move up by an additional 70 cents. And the closer you get to expiration, okay, the bigger what's called your gamma. You don't have to know all this to trade these. It's just, why is this such a good thing? The closer you get to expiration, the bigger your what's called your gamma is. So, which means the more your underlying market is more likely to actually mirror the underlying market. So basically get closer to a delta of 1, okay? And the less theta you have, and it's one of the phrases in option trading is theta is the price of your gamma, okay? So if you go in and you don't have very much theta, then you can have, but it's going to decay really fast because you're at the end, right? Then you'll have a lot of gamma. If you do like a leap option, your theta will be really low, but also your gamma is really low, so it's very slow for the option to move to mirror the market. So with these options, since you're right near expiration, 1 week, 1 day, or as little as 2 hours. I mean, you could even do it 15 minutes before. With these options, you have a very high delta as an end result. And then, really the other factor after you got, we talked about rho, we got delta, we got gamma, we got, theta, that's your time decay. So basically the premium in the option. And then the last piece of an option is your volatility. So your vega. And that's basically what is the expected move. And so that's a big piece they build in. And vega is actually biggest on options that are really far away from expiration or right before earnings announcements or right before news announcements, because they expect, if it's a long time from expiration, there's a big chance of a move. If it's right before earnings or news, there's a big chance of a move. And that's actually the number one most important factor in options trading is vega, because you can get what's called a volatility crush. So a lot of people go in and they start trading options and they're like, man, I'm going to start trading earnings because stocks always move on earnings, Yeah. And or not always, but like these stocks, they go and they get all the stats of how far a stock moves and everything, and they'll go in and they'll literally, like the day before an earnings announcement, they'll buy a call or put, and then they'll get what's called a volatility crush, and it'll suck all the premium out of the option. Well, if you hold on right there, we'll come back and we'll go a little bit more of the binary options. I'll make sure you understand it before we get off. That sound good?
Okay, sounds good.
All right, hold on, and I'll be right back with you right after the commercial break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
Catch Tom O'Brien and Steve Rhodes as they teach you the art of mastering money when it comes to trading and investing. The Money Masters, next on TFNN.
All right, welcome back to the Diagnostic Trading Hour here with Darrell Martin. Anthony, you still there? Hopefully I'm on the line still or not. All right.
Yes, I am.
Oh, you are. Great. Awesome. Okay, so wanted to wrap up a couple things here. We got a few minutes left before the show is over. But like I said, the quick summary is it's $100. Is the value of a binary option, and whatever you risk, the difference is your profit. And there's a couple ways that you can trade them, okay? So, of course, you could buy it and just hold it to expiration. That is one option. Or you can use them directionally based on like the standard deviation moves. You know, like we talked about the 9-point move, which would have been actually from the most recent high down from 1376. You know, would have been right down here to 13, you know, let's see here. We'll do the math and just bring it up on the screen so everybody can see it there in the Tiger Den too. And we'll also pull up a couple others. We got some more questions in the Tiger Den. We'll help those out. But if we looked at 1376 minus 9, we expected to move down to about 1367. And if you look, we're just within like less than a point of that. And you can see the market stalled right at that level. So, you know, definitely take advantage of these standard deviations. They're really helpful. Like I said, no matter what it is that you're trading. But you can do that. You can also, one of the things you can do is if you think, you know, based on it, like the thing's going to be at the most value when it's close to that price. So let's say the 1376. Now that was really your like expected high of the day. Okay, right here we're still in the middle, so we could also drop 9 points. All right, because the standard deviation is up and down. But when you're at, let's say, the high or the low of the standard deviation level, this is where you could look to what's called sell the binaries to make the premium. Okay, yeah. So you could have went in and you could have said, you know what, 1376, we're right there. I want to sell the 1380s, and you go at that level. And, you know, like obviously it's not worth anything right now because we're so far down already. But if you pull up the chart and you look at it and go, okay, well, what was it right around, let's see, 12:30 Eastern time? And let's see, so we'll pull that. There we go. And you can see what the value of that one was there. And we go in, like I said, pull up at sort of about 12:30 Eastern time. And it was right there at $26. And now it's, down like around $1 or so. If we pull it all the way out there, we'll see. So it's basically 50 cents a dollar on this. You could have basically collected that premium. Now, that's going to be a higher risk trade, but you're basically looking at what you think to be high probability. And notice, even though it was so close, they still did not have a lot of premium in there because they were factoring in standard deviations on the price. So what I recommend whenever I sell them, though, I usually don't sell like ones that expire at 4:15. I like to sell ones that expire like in 2 hours. So then you collect a lot of premium on them. You can also just go in for a quick pop. So, yeah, what question were you going to ask?
Yeah, I'm not a TD customer. How do you need to open an account to use that calculator?
You would actually have to. I think you actually can. You might be able to get a demo account with delayed data on there for the Thinkorswim platform. But also, one of the things we're actually going to be making, we're going to be releasing inside on TFNN.com. And we're actually working on launching all of it here in the next couple weeks. And I'm actually going to be putting a standard deviation calculator in there that you can take advantage of. So so it'll be really helpful for you. You can go in, you can type in some basic, like prices, like closing price and all that stuff. And what it'll do is it'll feed a lot of the information in, and you can take advantage of it.
Well, because that's why I was asking how to calculate it, because I wanted to try to get more familiar with using. This is the first time I'm hearing about, using the standard deviation, and so I've got. I guess I got somebody else that I have an account with, and I don't think they have the standard deviation calculator on there.
Yeah, a lot of them don't have it. They may have some sort of like standard deviation band you can check out. So what we'll do is we'll go ahead and put some more stuff in. If you want to also email me, dmartin@tfnn.com, and I can send some more stuff over to you.
Oh, that would be great.
Awesome. Well, thanks for coming on the show. And one of the questions I have, I'm going to go ahead and answer over the Tiger Den. But this is definitely way different than ATR. But I'll answer more details in the Tiger Den. Thanks for coming on, Anthony. Y'all have a great day, and I will see you tomorrow.